Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about WD-40 Co. annual report. The WD-40 Company offers a diverse range of products and services across various industries. The company's product portfolio includes maintenance products under the WD-40 Multi-Use brand, specialty maintenance products under the WD-40 Specialist brand, 3-in-1 brand products, including drip and specialty oil lubricants, GT85 brand e-bike maintenance products, home care and cleaning products, such as plus automatic toilet bowl cleaners, 2000 flushes, X-14, plus carpet stain and odor eliminators, Spot Shot, plus room and rug deodorizers, Carpet Fresh, 1001, plus bar soap and liquid hand cleaner products, Lava, plus carpet and fabric sanitizers and deodorizers, Novak. These products are sold through various channels, including hardware stores, online retailers, mass retail and home center stores, and independent bike dealers. The WD-40 Company's stock price has dropped by over 21% in the past year due to several factors. One major contributor is the company's underperformance relative to the broader market, particularly in the Americas region, where sales declined by 2%. Additionally, valuation concerns have been raised as analysts' price targets imply a significant increase in the future price-to-earnings multiple would be needed to justify these targets. Discounted cash flow, DCF, analyses also suggest that the stock may be overvalued. Furthermore, projected future margin compression and lagging revenue growth are expected to temper valuation expectations. These factors have led to analysts revising their price targets downward, resulting in the company's stock reaching a 52-week low of $193.64 USD in early October 2025. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, the introduction of new products and delivery systems, geographic expansion, premiumization, and effective management of business development activities have contributed significantly. The WD-40 Specialist product line has also been a major driver of revenue growth due to its category leadership and increased demand in various retail channels. On the decline side, changes in distribution and reduced demand in key markets, such as the US and UK, have led to a decrease in home care and cleaning product sales. Additionally, product quality issues and negative publicity have also negatively impacted revenue. Other maintenance products have also experienced a decline in sales. Neutral factors that have had little impact on revenue growth or decline include changes in foreign currency exchange rates, volatility in commodity prices, and foreign currency translation risk. These factors are external to the company's control and have not significantly affected its revenue performance. Net income increased by $21.4 million, 31%. For fiscal year 2025 compared to the prior year, primarily due to the release of an uncertain tax position. This growth in net income was also reflected in a rise in profit margins, with gross profit margin increasing from 53.4% to 55.1%. The increase in profit margins can be attributed to various factors, including the release of unrecognized tax benefits associated with the Tax Cuts and Jobs Act of 2017. This change indicates an improvement in the company's financial performance, driven by both increased revenue and more efficient operations. The company's financial performance indicates a strong ability to generate positive operating cash flow. The net cash provided by operating activities for the fiscal year ended August 31, 2025 was $87,925,000, and the operating cash flow is also reported as positive at $15.8 million. This suggests that the company has sufficient liquidity to meet its financial obligations and invest in growth opportunities. The company's debt level and interest expenses have seen significant increases. A review of the company's financial summary reveals a notable shift in its debt level and interest expenses. The data indicates that the company's debt has increased significantly, primarily due to borrowing agreements and potential future debt obligations. This increase is accompanied by a substantial rise in interest expenses, driven by variable rate indebtedness and potential interest rate risk. As a result, the company now faces higher financial burdens, which may impact its overall performance and stability. The company's financial performance varied across different segments and regions. The global operations outside the U.S. struggled, while unallocated corporate saw a decline of 1%. In contrast, EIMEA experienced a significant boost with a 12% increase in income from operations. The Americas remained relatively stable, albeit with some offsetting factors. Asia-Pacific also performed well, with a 4% increase in income from operations. Management's outlook on company strategy management is optimistic about the company's future prospects, driven by a commitment to research and development, innovation, and adapting to emerging technologies such as AI and machine learning. The company aims to maintain its corporate culture while navigating various risks and uncertainties, including supply chain disruptions, changes in tax laws, and fluctuations in business due to promotional activities. To mitigate these risks, the company is investing in additional headcount, information systems, and geographic expansion initiatives aligned with its strategic framework. Management expects to make progress towards cost of doing business and adjusted EBITDA targets over time, despite potential challenges from divestitures. The company's efficient business model positions it to manage through uncertain global economic conditions, and management is focused on managing liquidity and developing new opportunities for growth. With adequate resources provided by future cash flows, the company is well equipped to support capital expenditures, dividend payments, acquisitions, and share repurchases. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. Historically, it has paid regular quarterly cash dividends on common stock, with a recent increase from $0.88 to $0.94 per share in December 2024. Additionally, the company has authorized up to $50 million for share repurchases under its 2023 repurchase plan, with 50,250 shares already repurchased at an average price of $245.06 per share during the fiscal year ended August 31, 2025. Concerns about inventory buildup and supply chain disruption exist. The financial summary reveals that there are valid concerns regarding inventory buildup or supply chain disruption. Multiple pages highlight the potential risks associated with these issues, including relying on a limited number of third-party contract manufacturers and component suppliers. Page 5. Historical input cost inflation due to global market conditions, tariffs, plant capacity utilization, and natural disasters. Page 5. Volatility in costs of finished goods, components, raw materials, and transportation. Page 10. Concentration of inventory increasing exposure to risks associated with fire, natural disasters, theft, and logistics disruptions. Page 11. These concerns are further exacerbated by the potential for third-party providers to experience financial difficulties or business disruptions that could affect their ability to supply finished goods and raw materials. Page 7. That concludes the financial summary for WD-40 Co. Feel free to comment below, and I will be happy to answer them when possible.